Welcome to the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor and a better leader. Before we get to our feature guest for today, have to do our stock of the day. And again, no surprise, I think almost every day our stock of the day is Nvidia. Interesting note by the folks over at Evercore ISI ahead of Nvidia's February 26 earnings, pointing to three reasons why Nvidia's stock has underperformed the S&P 500 by 9% over the past month. That's something you never hear about. A couple things. DeepSeek potentially lowering AI demand in the aggregate. Number two, DeepSeek shifts AI compute cycles away from Nvidia chips into custom chips. Those are the ones being made by the likes of, let's say, Anthropic, of course, supported by Amazon. And last but not least, Blackwell chip delays. So a lot of focus on Nvidia into its earnings in just a few weeks. But this is a stock that continues to be defended by Wall Street. You go into Yahoo Finance, you click on Nvidia's ticker page, you click analysis, you see EPS estimates over the past 60 days have gone up for Nvidia, not down. The street still loves Nvidia. Again, Nvidia, our stock of the day. All right, let's get to our feature interview for this episode. Friend of Yahoo Finance, to say the very least, Torsten Slok, Chief Economist over at Apollo Global Management. Torsten, good to see you, my friend.
Thanks for having me.
I want to talk about tariffs. Did you see this news on the penny? We're going to stop making the penny. Does that make any sense?
I did see that. Well, there are some, of course, businesses that do use pennies, but it is, of course, quite unusual news, at least to say the least, to bring that up as an important issue.
Well, it's unusual, but maybe this is the new norm. Every day we're talking about tariffs here at Yahoo Finance. Now the latest that we're going to have reciprocal tariffs. We're getting 25% tariffs on steel. Help ground investors. Like how are you thinking about these tariffs and the economic impact?
Well, think about it. Most forecasters, of course, have a spreadsheet with the U.S. economic outlook either in their mind or literally in front of them. And the things that come in the door, both from the US administration, from Europe, from China, we try to plug into the spreadsheet and figure out, where should I put this in? Is this good? Is it bad? Which variables might it impact? Might it be important for inflation? Could it be important for unemployment? And the challenge is that a lot of these things are just really difficult to put in because, first of all, we can calculate that when tariffs come along, things probably do become more expensive. But at the same time, sales of the things that become more expensive might go down. So there's a lot of different assumptions that suddenly become very critical for how you put these things into your models and your frameworks for thinking about the US economic outlook. So it is quite challenging with a lot of different things coming in to understand and to figure out what is the weight we should give to this, and potentially how important could this be? And something like 25% on Canada and Mexico could obviously be quite important. So that's what people try to do is simulations show that GDP growth could be down as much as 0.5% if you do 25% on tariffs on Canada and Mexico and 10% on China. But the question is, okay, but will that happen? In what form? In what sequencing? So there's just a lot of questions that come up, in particular when it comes to the trade issues.
What do you think this back and forth on tariffs mean to U.S. GDP in the first half?
So now we only have 10% on China so far, but we may probably also get something on Europe. At least that's what Donald Trump has been saying. So at least at this point, simulations from the Tax Foundation, from the Peterson Institute, also from Cato, they do show that if you impose 10% on China, on average, it will probably lower GDP by 0.1 and probably raise inflation by 0.2. So that means it is by definition a stagflationary shock where we get a little bit less GDP and a little bit higher inflation. So the short run effects of a trade war is certainly painful. Even this might be small numbers, but it's certainly something that's negative. But the long run, of course, is that the economy could look quite different. So the question is, when we get from where we are today to where the president is trying to get us, it could be that over time, yes, it might be painful in the short run, but over time it could be that if the political desire is to have a different economy, then we will get to that economy eventually if you do impose these things.
The president would make the case, and he has made the case, that tariffs, I think he called it a big, beautiful word, but what is the longer term impact of tariffs? He has made the case that they are good.
Well, one challenge with that is that other than changing relative prices, meaning something becomes more expensive and something becomes more cheap, depending on which country you're in, there's also the other issue, namely that it also raises uncertainty. And there are a number of indicators of uncertainty. For example, Becker, Bloom and Davies has a measure of trade policy uncertainty. And that's today jumped up to levels that are higher than where it was in 2018-19. And if there's uncertainty, generally speaking, businesses look at their planning for hiring, planning for capex spending, and it could begin to have some negative consequences where businesses say, well, if I don't know what the playing field looks like and if it's level for the next 5 years, then I might not invest and build that factory in New Jersey. Maybe I'll say, well, let me hold off here and say I'm waiting with that investment, and maybe I may also be waiting with hiring. So the risk, of course, is that uncertainty generally is something that does have a negative impact on business planning.
One executive privately told me in the past 2 weeks that everything we're seeing on the economy, not the economy, tariffs, all the policy from the administration, is turning their business into a shit show. Those were their words, not mine. But, I mean, how much chaos is this causing?
Well, I think that when the uncertainty goes up, people generally start to pull back. And the issue, of course, is that that's not only for businesses, that's also for consumers. And the one example of that, of course, is Canadian consumers and Canadian press has been full of stories of Canadian households beginning to maybe think a bit differently about the US and think differently even about where they might go on vacation, what they might buy. So if you
that could be that's huge. That's like the knock-on effects of a trade war, right?
And those are exactly the things that are so difficult to put into the spreadsheet and into the models, because how do you know whether sentiment will change, both in the business world and also for households? We have seen more recently a few of the household sentiment surveys in the US have started to go down a bit. But if you look at capex spending plans for businesses have actually started to accelerate after the election. So the question is all still relatively recent over the last few weeks. So the issue still is, to your point, well, maybe we still have some tailwinds to the economic outlook that come from last year, namely high stock prices, high home prices. We have AI spending, we have data center spending, we have defense spending. But now we suddenly have some uncertainty factors that are a little bit harder to quantify in terms of what the impact might be, not only here today and tomorrow, but what the impact might be in terms of sentiment changing, in terms of planning for businesses and for households.
I mean, execs are having real trouble planning for their businesses. But, you know, outside of this discussion, we've heard Canada, Mexico, China. We haven't even talked about Europe. I was just at the World Economic Forum. I mean, I've seen you there for many years, Torsten. And
I missed our time in the snow.
Yeah, so do I. Yeah, it was nice. You know, it was good to catch up with you there. And President Trump came out very forcefully against Europe, saying we've been mistreated by Europe. He aired various grievances and kept it moving. But what if there's a tariff on the EU?
Yeah, so, I mean, the largest economies in the world is US, China, and Europe. So if suddenly we have a trade war here in the US with not only China, but also with Europe, and on top of that, also if we have one with Canada and Mexico, then global trade and the global business planning outlook could certainly be negatively impacted. So that's why there's a lot of different dimensions in terms of trying to figure out, for markets so far have said, this is probably going to have only a very small and modest impact. But the issue is that if you look at earnings in the S&P 500, 40% of earnings comes from abroad. So that means that if Apple sells fewer iPhones in Europe, if Coca-Cola sells fewer Coke cans in Canada, then you will ultimately have that the bottom line of corporate America could potentially be negatively impacted if you have a slowdown in the rest of the world.
One thing that I have never seen, at least over the past decade, or maybe even in my career, so China put Tommy Hilfiger on the blacklist. Never seen that before. Like, is that the bigger risk here from this trade war, that China clamps down on U.S. companies? We're talking about McDonald's, we're talking about Starbucks, even talking about a company like Nike.
Well, there is certainly, of course, a tendency, and this is not only the US, this is also China, and for that matter also the rest of the G7 countries that also is moving that direction of deglobalization or more segmentation of trade. Who are the ones you trade with and under what conditions? So if you do have that the world order is moving from a lot of globalization where goods are produced in the place where they're produced the cheapest, so now suddenly goods have to be produced also in Europe, but in the US also in your own backyard, even though it's more expensive. It certainly comes with some different implications for the global economy, especially this issue around what is the price of the goods that we're buying in the US, what is the price of the goods you're buying in Europe, where is it produced, and are there certain countries that we would like to trade with, certain countries that we certainly don't want to trade with. And given that, for example, China has specialized in a lot of things in renewables, EVs, batteries, windmills, solar panel production. And if suddenly now the gates are going up, not only in the US, but also in Europe, that means that there is excess capacity, for example, in China for exporting those things. But now there are markets who normally absorb it are not able to do it. So this segmentation of the global economy is certainly something that has and will continue to have important implications.
Why isn't this recessionary?
So I think that still this is relatively new, and I think also that the tailwind, at least from the animal spirits that were released after the election in November in the surveys, I do think that that ultimately is a trade-off where that's being helpful versus some of these things potentially being in the short run more painful. So that's why up on the scale for investors, it's, well, what are the positive things from deregulation, from potentially lower taxes? And on the other side of the scale is this risk that we might have some uncertainty as a result of tariffs and trade policy in the near term.
Are you surprised that markets are still trading where they are?
Well, I think that the AI and the story about the Magnificent Seven in the US just continues to be incredibly strong.
I love your charts on this stuff. I mean, for listeners who don't get Torsten's work, I mean, he sends these just bite-sized nuggets of awesomeness, charts, data points. We love this stuff at Yahoo Finance.
Daily Spark.
Yeah,
you can sign up on the Apollo homepage. So yeah, we try to, of course, understand why is it that the markets have been trading still in such a positive way, despite some of these fairly disruptive news we've had in the last 2 weeks. But I think that there's a lot of discussion around how much will we actually see, what will the magnitude be, which countries will be hit. So because we haven't seen that quite yet, and Monday last week, we almost got 25% on Canada and Mexico, then that was delayed 30 days. So we should wait maybe 30 days to therefore figure out if this actually becomes law or if this actually is something that will be implemented or not. So it's the uncertainty, not only around what will it mean ultimately if you did do this, but also the uncertainty around how much of this will actually get done.
This stuff is just chaos, Torsten. I'm just listening to you. There's just so much going on.
Well, and that's why the quantification challenge, I mean, think about my job. It really literally is sitting in front of a spreadsheet all day long and trying to figure out what are the implications of what I'm seeing in Yahoo Finance and all the other news channels for my outlook. And if the implications are really hard to quantify, then you scratch your head and say, okay, I don't really know how to stuff this into my spreadsheet. And therefore, maybe at the moment, I should just say, well, let me keep on watching until I figure out if this is actually happening or not.
All right, hang with us, Torsten. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Talking to Torsten Slok, Chief Economist at Apollo Global Management here at the NASDAQ in Times Square. We're back on the second floor here at the NASDAQ, our home base. Love being here. Of course, we also should mention Apollo is the parent company of Yahoo Finance. Torsten, we haven't even talked about Fed policy. And when I think tariffs, I think inflation. I mean, a lot of people have come on this podcast and argued that they are not inflationary. I think they are. What say you?
So the broader backdrop for the U.S. economic outlook is that we come into 2025 with very strong tailwinds. And those tailwinds, in particular from high stock prices, AI data center spending, defense spending, we have significant support still from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. And now with basically 3% GDP growth, normally it should be 2% according to the Congressional Budget Office, and at the same time 3% inflation. If we now add some policies such as tariffs will by definition make things more expensive, and if you also add restrictions on immigration will by definition increase wage growth in certain sectors of the economy where unauthorized immigrants work, namely construction, agriculture, and services. So if with that backdrop we have policies that are now lifting inflation modestly from an already too high level, then my view would certainly be that then maybe we are not done for the Fed with hiking rates. There is a risk that we could still have a rate hike later this year if you both have strong tailwind.
Finally, someone came out and said it. I've been trying to get to this. Yes, I mean, it makes sense.
I think actually it's quite simple. We have a strong economy, and I add policies on top of that that potentially could give at least a modest lift to inflation, namely tariffs, restrictions on immigration, and maybe even also lower taxes on domestic manufacturers. Trump has talked about lowering taxes on domestic manufacturers to 15%. All those things, at least a modest lift in inflation, some lift also in GDP, that would argue for the Fed still being in play in terms of potentially having to raise interest rates later this year.
Then how, we have Fed Chief Jerome Powell's giving his semi-annual testimony this week. How does he signal a rate hike, and when could he signal a potential rate hike?
Well, the challenge for him and the FOMC is that the Fed has really gone in recent speeches by FOMC members from being data dependent to being policy dependent. Now they are essentially saying the incoming data is strong and the economy is still doing well. He keeps on saying that. He said that at the last press conference. But now also at the same time, there's uncertainty about what's coming. And as we just talked about before, if we don't know what's coming when it comes to tariffs, restrictions on immigration, on lower taxes, then they are having probably similar challenges with the spreadsheet that I'm having with my spreadsheet, namely figuring out, okay, but how do we then put in a forecast? They need to put out their dot plot, the ACP, the summary of economic projections, that has their estimates for what do they think unemployment, inflation, etc. will be for the next several years. And these numbers they need to publish. So that's why for them, it really is a challenge of figuring out how do we make an assessment of these things that may or may not be coming in terms of what should we be doing today.
One rate hike?
So I think that at least initially, of course, if you go back and look at history, the first hike, the worst way to look at that, the first hike could potentially come already in June. Normally, when the Fed stops cutting rates, it has, in the historical data, taken in some cases only 7 months before they start hiking again. So I would say the first brush at this would try to look at historically, it could already be sometime this summer. But if we have significant increase in inflation because of a strong economy, strong GDP, strong inflation, and potentially some policies that give a modest lift to inflation, then you could have several hikes later this year.
I'm doing it. I'm counting underneath the table here. 6 months in advance. Market moves 6 months in advance. The market hasn't priced in any rate hikes.
No, markets, because FOMC members are still generally, they are backtracking a little bit here, but they're still talking about that the next move should be a cut. And if you look at, of course, the futures market, SOFR futures curve is predicting that we'll get 2 more cuts this year. So there's a very important debate around, well, it used to be that there were many more cuts priced in. Now we're only 2. Is there something non-linear or something disruptive if we suddenly go to, well, now maybe hikes are coming back? Because if that's the case, then the 60-40 portfolio that did so poorly in 2022 when rates were going up and stocks were going down, could it be that therefore we would have again later this year, similarly, that stocks would go down and rates go up again, and therefore the 60-40 portfolio will be underperforming once again, just like it did in 2022?
So we were talking about tariffs adding to inflation. Now, my mom always asked me, why are my eggs still costing so much? Why does everything feel more expensive? Like, let's strip aside tariffs. Like, why do things feel and look expensive still? Well,
I think the main problem is that since January 2020, the price level of the CPI, meaning the price of everything that you and I buy on average, is up 25%. So that means that if you look just back at what was the price of everything on average in 2020 that you bought in stores, your rent, everything you do when you go out to eat at a restaurant, literally everything is 25% more expensive. And you have basically almost never seen the price level go down. The inflation rate can certainly slow down, which it has done from 9% to roughly 3%, but you basically never see the price level go down. So that's why the price of eggs can go down and the price of coffee can come down. It is expensive at the moment, but on average, it is just almost never the case that we see the price level in aggregate come down. And that's why it feels expensive, because housing is expensive, tuition is expensive, healthcare is expensive. Those are some of the components that have seen the biggest increases over the last 5 years.
I remember I talked to Walmart CEO Doug McMillon about a month and a half ago. They won our Company of the Year award for last year. I asked Doug too, like, when are prices coming down? He suggested that they just may not. Is that valid? Do we need? I guess, do we need a sharp slowdown to get prices to come down?
Yes. And we should not want that, because in that case, if we have a deep recession and we have a period like in the 1930s or other periods where we had deflation, then of course the unemployment rate at that time was 20%. So I'd rather have my job and then see things a little bit more expensive. But I think you're right. We will really not see the price level come down. Egg prices, of course, again, and other things, individual things we buy, Cheerios, might begin to become more expensive, but in aggregate, things have just reached a level that's higher. The good news for consumers, of course, is that wages have also gone up, and for the average consumers, wages have actually gone up more than 25%. So it is just this feeling and this sentiment, and therefore inflation expectations, that are importantly impacted when the price level suddenly from a few years ago is so much higher than where it was in 2020.
You interact with a lot of really sophisticated investors. I mean, these are investors with large sums of money in markets. What are some of their biggest concerns for the balance of this year?
Well, I think that there are 3 different concerns when it comes to the overall macro outlook. One issue is this thing that we're talking about, namely what exactly is happening on the policy front in the US. How do we assess this? How do we put this into our spreadsheets? The second thing is that China is unfortunately in quite serious trouble at the moment. There are three things that are holding growth back, namely demographics are slowing things. Remember, China had a one-child policy, which means that over the next 10 years, according to the United Nations, the workforce is going to shrink from about 1 billion to 900 million. That's 100 million people that are leaving the workforce. That's a fairly significant headwind to the Chinese economic outlook. Second, China is also experiencing a housing bubble that's bursting, and China is also in a trade war, not only with the US, but also with Europe. And because of these headwinds to China, that's also dragging down growth in Germany and Europe, because Germany and Europe normally exports a lot of things to the Chinese economy. And if China slows, Europe also slows. So the second problem is global growth is unfortunately under some downward pressure, while US growth actually continues to have some tailwind. And the third problem, therefore, is, as we spoke about earlier, that if 40% of earnings in the S&P 500 comes from abroad, if the rest of the world is bad, well, then that will also weigh, therefore, on the earnings outlook for the S&P 500 companies. So yes, the US is a closed economy, and yes, the US is living as a closed economy that is different from the rest of the world, which essentially is an open economy. But through the multinationals, if the rest of the world slows down, it could ultimately begin to have some negative implications, especially for the S&P 493, meaning those companies that export but are not in the Magnificent Seven.
Awesome. We always love to close our show with hot takes by our guests. So if you and I are sitting here 4 years from now, how do you think we would describe the Trump economy in one word?
I would say strong, because I do think that there is a lot of tailwinds coming from the significant increase in sentiment indicators for businesses in the last few months. I think CapEx spending also has been very strong. So I would expect strong, but with some uncertainty about the negative consequences of the trade war, because there are some issues around what might this all mean in terms of how much upside pressure on inflation that we might begin to see.
All right, can I plug that blog, the Daily Spark?
Daily Spark.
Over at Apollo?
Absolutely.
Okay, I mean, it's must-read stuff. I mean, this guy's been I've been following him for over a decade. Torsten Slok, always nice to see you. You've always been very generous with your time.
Oh, my pleasure.
I really appreciate it.
Thank you.
All right, and that is it for the latest episode of Opening Bid. Be sure to hit us with those 5 stars on Spotify and Apple Music. Keep those comments coming on YouTube. I'm really have been diving into them more so lately here, trying to get to replies. I appreciate all the feedback. It makes this podcast even better. That's it for the latest episode of Opening Bid, and we'll talk to you soon.